Hello. In this video, you'll learn how accountants use the General Journal. We'll talk about how to record Eli's consulting business transactions in the General Journal. We'll learn about proper documentation and the audit trail. But we'll start off by recording transactions with one debit and one credit, but then learn about compound entries, journal entries with more than 2 lines. The accounting cycle is a series of steps performed during each accounting period to classify, record, and summarize data for a business and to produce needed financial information. The first step in the accounting cycle is to analyze business transactions. We did that in chapters 2 and 3. The second step in the accounting cycle is to prepare a record of business transactions. Business transactions are recorded in a journal, which is a diary of sorts of business activities. The journal lists transactions in chronological order, that is, in the order in which they occur. The journal is sometimes called the record of original entry because it's where transactions are first entered in the accounting records. There are different types of journals. We're learning the manual way of recording a journal. However, in most businesses, even small ones, journal entries are entered into an Excel template, and often macros in the Excel template will automate the posting of the journal entry to the general ledger. Here's an example of what a journal entry Excel workbook might look like. The top section needs to be filled in by the preparer of the journal entry. The preparer enters their name and the date of the entry and selects the entry type from the drop-down list. One-time entry, reversing entry, recurring entry, or error correction. Your company could have different types of entries. However, auditors often want to be able to see monthly reoccurring entries separate from one-time and error corrections. Next, enter the date and the journal ID as well as the entry summary. Then the journal entry is entered into the line items, and there's a double check in the template right here that lets you know that the entry is balanced, meaning debits equal the credits. If they don't balance, typically this field will say not balanced and appear in red. Once the journal entry has been completed, the preparer would send it to the reviewer. And once the reviewer approves and enters their name and the date of the approval, the entry can be posted to the general ledger. Once the approval is complete, the entry can be posted to the general ledger. We'll now record the journal entries for Eli's consulting step by step. For the first transaction, Trade and Eli obtained the funds to start the business by withdrawing $100,000 from his personal savings account. To start the journal entry, you'll leave a blank line between general journal entries, and some accountants use this blank line to number each journal entry. When possible, the journal entry description should refer to the source of the information. For example, the journal entry to record payment should include the check number in the description. Accountants use journal entry numbers to identify journal entries. Document numbers are part of the audit trail. What's the audit trail? The audit trail is a chain of references that makes it possible for someone to trace information, locate errors, and prevent fraud. The audit trail provides a means of checking the journal entry against the original data on the documents. And documentation is critical. The external auditors will want to review the supporting documentation at year end. However, sometimes the supporting documentation is confidential, like severance amounts when there are company layoffs. In those cases, the journal entry will reference the person or department that can provide documentation upon request. The supporting documentation for the $100,000 contribution is a memorandum from Trayton Eli to Sergio Sanchez. Additional documentation might be the deposit into the business's bank account and legal documentation that shows Trayton Eli gave Eli's Consulting $100,000. To record this business transaction, we debit cash for $100,000 because cash is an asset and assets increase with debits. Therefore, a debit to cash for $100,000. For our credit side, our capital increases and owner's equity, which capital is part of, increases with credits. Therefore, a credit to Trayton Eli Capital for $100,000. On November 7th, Eli's Consulting Services issued check 1001 for $5,000 to purchase a computer and other equipment. We can see the journal entry documentation, but in a real company, this support would not be sufficient because it does not even provide the details of the purchase, model number, specs, etc., and evidence that Eli's Consulting paid the information technology store. This document looks like it's a check stub from a checkbook. The necessary documentation in this case should be a copy of the invoice from the information technology store. The invoice should detail the items that were purchased and should show Eli's Consulting Services as the purchaser. Accountants are responsible for verifying proper documentation before recording any entries. So for this transaction, we debit equipment and credit cash for $5,000 once the proper documentation has been received. On November 10th, Eli's Consulting Services purchased office equipment on account for $6,000, and we have the invoice here from Office Plus. The invoice shows an invoice number, date, order number, shipping and payment terms, the name of the buyer, and item details for what was purchased. This invoice shows the right level of support. Please be aware that many businesses do not record assets for equipment and supplies that cost less than a certain amount, like, for instance, for calculators. The threshold depends on the size of the business. The accountant should ensure accuracy of the invoice in the payment terms as well as the proper purchase order number. In addition, the accountant needs to ensure that the correct sales tax is calculated. So for this transaction, we debit equipment and credit accounts payable for $6,000. On November 28th, Eli's Consulting Services purchased supplies for $1,500 with check 1002. Again, this is not proper documentation. We don't have an invoice. In fact, we don't even know if supplies were purchased. We also don't have a copy of the check. This would not pass during an audit, and I would be concerned if a business owner provided this as a receipt. During an audit, the auditor would ask for the invoice from Office Deluxe, a copy of the canceled check, or other proof that the amount was paid. In some cases, the auditor might even ask for verification from Office Deluxe directly. For this business transaction, we debit supplies for $1,500 and credit cash for $1,500. Why? Well, our supply assets increased, and assets increased with debits, and our cash decreased. Cash is also an asset, and assets decrease with credits. For the fifth business transaction, we debit accounts payable for $2,500 and credit cash for $2,500. Why? Well, our accounts payable decreased, and accounts payable are liabilities, which increase with credits and decrease with debits. We credit cash because it's an asset and it decreased, and assets decrease with credits. For our sixth transaction, Eli's Consulting wrote check 1004 for $8,000 to prepay rent for December and January. Again, this isn't proper documentation. In this case, I would like to see the rental agreement and a copy of the check or other payment remittance. For this business transaction, we debit prepaid rent for $8,000 and we credit cash for $8,000. These 6 business transactions and journal entries are for revenue, expenses, and a withdrawal transaction. Revenue transactions should be supported by invoices and potentially a contract between the client and Eli's Consulting. The supporting documentation for salaries and wages is the payroll register, and the support for the utility expenses is the utility bill. For Trayton Eli's withdrawal, I would like to see a document signed by Trayton and acknowledging that he received $5,000. Now let's talk about the journal entries. For the 7th transaction, Eli's Consulting performed services for $36,000 cash, which means that we need to increase cash, which we do with a debit of $36,000. Our fees income also increased and revenue increases with credits. Therefore, we'll record a credit to fees income. For the 8th transaction, Eli's Consulting performed services for $11,000 on credit, which means that we need to increase accounts receivable, which we do with a debit of $11,000. Our fees income also increased and revenue increases with credits. Therefore, we'll record a credit to fees income of $11,000. Next, for our 9th transaction, we received $6,000 cash from credit clients who previously received services on credit. In this case, we'll debit cash because our assets increased, and we'll reduce accounts receivable with a credit of $6,000. For the 10th transaction, we paid $8,000 in salaries and need to increase our expenses by debiting salaries expense for $8,000 and reducing our cash with a credit of $8,000. The 11th transaction is very similar, but we debit utilities expenses and credit cash. For the last transaction, we need to debit the drawing account and credit cash for $5,000. There's some transactions that consist of more than one debit and one credit and requires a compound entry. For instance, on November 7th, the firm purchased equipment for $5,000 and issued a check 1001 for $2,500, and agreed to pay the balance in 30 days. The journal entry debits equipment for $5,000 and then credits cash for $2,500 and credits accounts payable for $2,500. Here's another example. In our second example, the firm purchased office equipment for $2,000 and office supplies for $500 with check 1002 on December 14th. For this business transaction, we would debit office equipment for $2,000 and debit office supplies for $500 and then credit cash for $2,500. Hope this overview over general journal entries was helpful.